I talk to them about being like a group of junkies who've relapsed, going, listen, man, I just need some liquidity, you know what I'm saying? I just ran into some bad subprime, you know? We just had complex formulas. We just didn't factor in greed and panic, you know? I just need $805 billion by Tuesday. Yeah, no, seriously. No, I would not screw you again. It's pretty crazy.
I've learned my lesson.
No, baby, this is not like the other time. Seriously, I just throw me a bad here, baby. Help me out.
Just give me a little bit.
Yeah, just a taste. That's all I need is a taste. I need $2.5 trillion. I'll pay you back.
Hey there, YouTube family. Robin Williams absolutely nailed that commentary and that humorous criticism of the banking industry and the politicians that are always there to keep them served with that money crack stimulus that they're always coming back looking for. Hey, give me another 2.5 trillion just to get me through the day. Robin Williams, man, you were hysterical. Anyways, what really got me triggered this weekend was a commentary by Janet Yellen. She came out yet again, and repeated her stance that the banking industry is really stabilizing after a tumultuous March. Treasury Chief repeated that the government will act again if needed. And if there's one thing that I've learned about Yellen, is that when she comes out and tells you everything is okay, it is 100% that it is absolutely not okay. When she comes out and says it's all good, you want to know it's all bad and that we're getting closer and closer to a potential breakdown. She was asked, didn't you guys miss it? Didn't you guys miss the fact that this fast exponential raising of rates was going to cause serious problem to the bond portfolios, increase the risk of the banks exponentially and cause a major collapse or a credit crunch in the days ahead? And she said, no, we didn't do that. We didn't make that mistake at all. Well, they absolutely made that mistake. The banks knew it. Everybody knew it. Since 2022, every single month of 2022, when the Fed was raising rates, the bond portfolios were collapsing. This was not a surprise. The question that was had was how bad was each bank off? How bad was each bank being managed? Nobody per se would have known that, but they would have known that they were all in trouble. And so she's just yet again making the rounds. In my mind, she's making the rounds and sending out a warning for those who have the right ears to hear. Let's go over some of the things that we know for sure. We know that 60% of all the loans that are given to small businesses are given by small regional banks. So that's a lot of liquidity that goes from the regional banks to the small businesses. Now, if you didn't know it, small businesses make up over 99% of all of the businesses in the U.S. So if the small banks provide loans to small businesses and they can no longer provide those loans because they don't have the money and the government's not going to bail them out, they're only going to bail out the big banks. If the small banks do not get the money, it doesn't go to the small businesses. They don't have the ability to hire. They don't have the ability to take on new jobs and to grow their business. And so it's going to have a massive impact on employment through the small businesses, because the small businesses in America employ 50% of everyone that's employed in the U.S. And so we know for a fact, because of those basic things I just gave you, that we absolutely have a coming credit crisis. And I think everybody knows it. Janet Yellen knows it, the Fed knows it, Biden knows it, everybody knows that we've got a coming credit crunch through the small banks, and there's really nothing they can do about it. They're going to prop up the banks that are too big to fail, and the small banks are going to begin to fall like dominoes. You see that by looking at the SPDR, the S&P Regional Banking ETF. It hasn't bounced. After a 30% drop, it's still down at the floor. Everybody knows that these guys are in trouble, and the smart money is not going to pile back into that until all the problem gets washed out. I want you guys to keep in mind that SVB had $20 billion, less than $20 billion. It was closer to $16 billion. They had less than $20 billion in potential losses in their bond portfolio. It is understood right now that the banking industry collectively has $620 billion of bond losses. And so the SVB was truly just the tip of the iceberg. There's a much bigger problem beneath. But why have the markets been climbing? All right, well, I'm going to cover that. I'm also going to cover a small stock that I gave you guys last week. And I'm going to answer the question, why are these markets climbing? And what could change that direction in the days ahead? This is the Stocks with Josh show. It's a beautiful May day. May the 4th be with you. We're going to cover those things and the JOLTS data and how it impacted the market today. Thank you guys for already hitting the like, hit the subscribe and the YouTube bell notification to get my daily videos on stocks and crypto. Quick update on a call that I made last week. If you follow this channel, you know that I was celebrating my daughter's wedding this last week, and I didn't make a lot of videos, but I did make a video and I did make a call last week that I want to review with you guys on SoFi. I told you guys that on the day that it was $5.50, I said that I expected a very quick move up to $6.20, and it did just that. It went up and touched $6.28. So that is a completed call. Small traded, but it's still a win. If you took my call seriously, you may have made some money alongside of me. Now, if we close above $5.98 today, we should see it continue higher, and it could go to $6.33. Otherwise, support below is at $5.77. I want to make videos on all of my trades, but I have limitations. I have limitations in my time. I also give technical updates in the chat group that I host over on the Moomoo investment app. And if you guys need better trade tools and you want to get more connected, you can go over and click on the link in the top pinned comment. They're offering you a pile of free stocks to open and fund an account. You can click on the link to get all of the details. It's a limited and exclusive offer. I enjoy Moomoo. I use it every day for their free level 2 data. They've got 8 order types. It's like doing conditional trading. And they've got a free stock screener, which I use every day. And that's where I host a chat group called Stocks Josh Family. And I talk about other stocks and I answer questions on other stocks that I don't get to cover on this page. Click on that link, get the free stock, start investing today, and then come find the chat group. Okay, today we got the JOLTS data, and that didn't have very much of a big impact on the market. And I'm going to analyze why that was. But what it specifically happened is that we saw that job openings tumbled below 10 million in February. This was the very first time that we've seen this decrease in the last 2 years. And so this really should have been good news if the old narrative that bad news is good news because it could move the Fed is still in place. But has that changed? Is this the first signal now today that bad news is going to begin to be bad news because the fear has gone from the Fed to potentially recession and deflation, because that's what this would signal. The labor market beginning to soften up would signal that we're having a problem. We're going to see more layoffs. Those layoffs are going to lead to less spending, and the less spending is going to directly impact every single American business and their earnings. They want to see margins increase. They want to see debt decrease. They want to see companies moving up and doing better. And whenever you're moving into a recessionary environment, there's simply no room for stocks to go up, because stocks only go up when the profit margin and the companies grow, not when companies are going to begin to lose value because they're facing a recession. And so the JOLTS data might have been an early signal that we're moving into a time when bad data is going to mean a bad effect on stocks and stock value. We also saw the first sign of layoffs outside of big tech. McDonald's is preparing for layoffs. This is now the service sector, which shows that the impact of a potential recession is beginning to take root in more industries than just big tech. The news article read that McDonald's closes corporate offices as workers await layoffs. So even though we're continuing to get more bad data, overall, for the last couple of weeks, the markets have been climbing. Why have the markets been climbing? Well, the big answer is that the market believes that the Fed is positioned to go back to pumping liquidity into banks to prevent a massive banking crisis. In addition to that, the market is taking notice of the fact that Japan and China have already, these are very large economies that are already pumping liquidity back into the global economy, which absolutely impacts American companies. So you got the 3 largest economies on earth pumping liquidity. M2 money supply is turning up from its cycle lows. And between the fact that we've got the M2 money supply increasing and we've got these 3 groups, the US economy, Japan and China, pumping potentially with the US, but Japan and China doing it right now, pumping liquidity back in the system. The more money that goes back in the system, the better stocks are going to do. But the reason why we saw the market run all the way up to 4,200 on the S&P 500 and then stall out is that the truth is we don't have enough data. We don't know if the next corner we turn, we're going to see a massive banking collapse. We don't know whether we're going to see a ton of more bad deflation data, or we begin to see, when the next round of earnings come out, positive earnings reports from all the companies. The stock market is very likely going to move sideways until we get the data that we need. And one of the data points that is ahead of us in the month of April, April 27th, is going to be Q1 GDP. That's going to tell everybody whether the economy is dramatically slowing down. That would be a big bad news event. And if on that event you see that stocks are falling, then we're going to know for certain that the smart money now believes that the biggest risk to the value of stocks is not the Fed, but rather the coming recession and deflation. And that's where you could begin to see the bigger move down, that 30%, that 50% potential move down. But until we get to that data, I think we're going to continue to move sideways and even possibly higher. I think that there's, as I said in the last 3 videos and some of the big tech companies that I cover, there's just a little bit more room to the upside. I think we're going to hit those key technical levels, and then I think we're likely going to sell off. That's all I've got for you guys today. I'm thinking of doing a lightning round on a bunch of stocks tomorrow. So in the comment section, let me know the stock that you would most like me to cover. Again, if I don't cover your favorite stock, you can always come find me in the chat group over on Moomoo and ask me directly, and I'll try to give you a little bit of feedback on the stock that you're interested in. That's all I've got for you guys today. Make this a quick video. Peace and blessings, my friends. Thank you for hitting the like, hit the subscribe and the YouTube all notifications bell, and I'll see you in the chat. Take care.